Hello students and welcome to this explanation on standard costing. I have a question here. It's called electronic control systems and it has a standard absorption costing system that I want us to apply here. It says that this business manufactures electronic components for the mining industry and they use the absorption costing system to value the products. No inventories are kept and they operate in a just-in-time purchasing and production system. The standard production costs for the components are as follows. And this is one of the reasons why I chose this question. You will observe that they did not give you like the information in a standard cost card format or the way that it is normally given. It is written in sentences and you will find that the unit cost was not given. So the next paragraph reads, direct material is 8, and this is now the standard information. Please note, I just want to highlight that important sentence. So they say for direct material, it's 8 kilograms at 10 Rand 80 per kilogram. The direct labor is 1.25 hours at 18 Rand per hour. The variable overheads is absorbed on the basis of direct labor hours at 6 Rand per hour, and the standard selling price is 180 Rand for a unit. Then the fixed overheads are also allocated to the product on the basis of direct labor hours at 13 Rand 60 cents per labor hour. Then they give you the budgeted production and sales, and they say it's calculated to be 10,000 units. In the next block, the actual data is given. So the actual production and sales was 9,000 units. The variable overheads added up to 70,000. The direct material was 74,000 kilograms at 11 Rand 20 for a kilogram. The actual selling price was 184 Rand. The fixed production overheads total 168,000. And then the direct labor was 10,800 hours at 19 Rand an hour. In the required part, you need to reconcile the budgeted and actual profit by calculating all the possible variances. All right, so where I would start in this question is that it is not given in the traditional format. So I need to sort out the information for myself in a way that I can understand. So here I will start by saying, all right, I have my type of input like material, etc. Then we have our input amounts and we have our unit values. So I'm going to start with direct material. And for the direct material, we were told that the input was 8 kilograms at a total of 10 Rand 80 per kilogram. So to get to the unit value, I will have to multiply that. So I'm going to say 8 times 10 Rand 80, and that gives you a total of 86 Rand and 40 cents. The next is direct labor. And for direct labor, we were told that it is 1.25 hours and the rate is 18 Rand. And that gives us a unit value if we multiply it of 22 Rand 50, if I'm not mistaken. So it's important to pay attention to the difference between a unit and an input. So an input is anything that is measured in terms of a measurement type. So it could be an hour, a kilogram, a meter, a liter. So those are input types. A unit value is the total multiplication of the input information. So you take the type of input total times the input price, and that gives you the unit value. So it's very important to understand what constitutes an input versus what constitutes a unit. So, and please note that inputs are parts of what we are producing. So for direct material, the input may be the wood required, and for the unit, it's all the wood needed to make a complete product. Right, then we are on variable overhead. And we were told that it is allocated on the basis of direct labor hours, which is 1.25 hours, and the rate we are told is 6 Rand. And if I multiply these input values, I get 7 Rand 50. Then we are on fixed overhead. And for the fixed overhead, they say it's also on the basis of direct labor hours, and there the rate is 13 Rand and 60 cents. If you multiply those input types, you get 17 Rand per unit. All right, so now I've put the information in the traditional way that you would have found the information in your textbook. So now we can move on to doing the actual calculations that are required. So I do a number of calculations and a number of steps before I can actually answer the question. It's a lot of calculations, but it ensures that you are able to get the maximum number of marks for your reconciliation. And the first step that I do, I simply call the block. And it works as follows. It does calculations for direct material, direct labor, variable overheads, and sales price. And it works as follows. It consists of 4 columns, of which the first one is used as a description. In the second one, I take the actual units and I times it by the standard unit value. And this may not make sense right now, but I will explain. In the second column, so please note this is support calc 1. In the second column, I'm going to take the actual input times the standard price per input. And then in the third column, I'm going to have my actual results. And the actual results are basically what really happened in the business by year end. And those are typically the amounts that you will find in financial accounting. So if we account for transactions historically, those are the actual results that you find in your income statement, for example. Right, so my first type that I can calculate in support calc 1 is my direct material. And for direct material, I'm going to say actual units times the standard unit value. So if I go back to the question, you will see that the actual production and sales units was 9,000. I'm going to take that 9,000 and I'm going to multiply it by the unit value for material, which was 8, 6, and 40 cents. Under actual input, I need to go and see what input type do we use for materials. And the input type is kilograms. Going back to the question, I'm now seeking the actual total kilograms that is used for material. And the actual kilograms was given as 74,000 kilograms. So I take that actual input, the actual kilograms, and I times it by the price per input. Now you need to be careful. You cannot use the unit value. You must use the input price. So the standard price per kilogram was 10 Rand 80. So I'm going to multiply there by 10 Rand 80. The actual results, if I go back to my question, it is the 74,000 kilograms at 11 Rand 20. So I will simply multiply the actual results. So it's the 11 Rand 20 at 74,000 actual kilograms. I've completed my first line item calculation. And now I will continue to do this calculation for direct labor and variable overheads as well. For direct labor, I'm going to say the actual units is still 9,000 and the unit price for direct labor was 22 Rand 50. The actual input, I need to go and find the input. And the direct labor was based on direct labor hours. If I go back to my question, the actual total direct labor hours was 10,800 hours. So I'm going to take that 10,800 hours and I am going to multiply it by the standard price per input, which is 18 Rand. My actual results is the 10,800 hours times 19 Rand. The next line item I can calculate in support calc number 1 is my variable overhead. And again, I am just going to use the same line of thinking in doing the calculation. The actual units is 9,000. The unit value for variable overheads is 7 Rand 50. The actual input, it's based on labor hours as well, and the actual labor hours was 10,800, and the standard price per labor hour for the variable overheads was 6 Rand, so I'm going to times it by 6. The actual results were given, and we are told that it was 70,000 Rand, which I will fill in under actual results. The last type that we can calculate in support calc number 1 is the sales price variance. And it's the sales price variance that we need to pay attention to in terms of actual input. So the sales price, and then calculating sales variances, you already have a complete product. So the sales price variance is not related to any type of input, such as kilograms, meters, liters, hours, etc. So the middle column for it must remain blank. So I always just make a cross in it or an X in it, because it must not be filled out, because we cannot calculate an actual input relating to sales. For the sales price in the first column, there are actual units, which was 9,000. And if we look at the standard selling price, I just want to go back to the question. The standard selling price was 180 Rand. So we do have actual units, and we do have a standard selling price per unit, which is 180 Rand. The actual results of the sales price was, the price was 184, I think. Yes, the actual selling price was 184 and the actual units was 9,000. So I'm just timesing my actual information to get to an actual result, 184. Right, support calc number 1 done. So you might be thinking, why am I doing all these calculations? Well, I'm doing all these calculations because from this block, you can now calculate your variances that relate to material, which is your quantity and price, your direct labor, which is your rate and your efficiency, your variable overhead, which is rate and efficiency, and also your sales price variance. Because let's suppose this is called column number 1, column number 2, and column number 3. If you want to calculate your variance that is related to a price or to money or to wage or to cost, it will be column 2 minus column 3. If you want to calculate your variance that is related to efficiency or that is related to quantity, it will be column number 1 minus column number 2. So it's as simple as that. So you don't have to remember any formulas if you just apply this calculation. Right, let's move on to support calc number 2. So support calc number 2 is all about calculating your fixed overheads. So fixed overheads cannot be calculated in support calc number 1. They are, as I always say, their own ball game. And it's really not as difficult. So you will remember that we have 4 basic fixed overheads that need to be calculated. We have a fixed volume, which is split into a capacity plus the efficiency variance, and then we have what we call an expenditure variance. So to do those 4 calculations, it's pretty straightforward if you also follow the following calculatory tip. So in support calc number 2, I use a block again, and I call this block FAB. And I call it FAB because it consists of the following columns. It has what I call flexed hours. It has what I call actual hours. And what we call budgeted hours. And then we have in the final column a budgeted rate per input. Now, at first, this may seem very, very difficult, but it's not. So this relates to fixed cost, and the first thing you need to ask yourself is, if I calculate fixed cost, on what basis is it allocated? And in this instance, we were told in the question that it is also allocated to the product on the basis of the direct labor hours. So already the actual hours are very easy because the actual direct labor hours were given. It's 10,800 and I can go and fill it out. Then the budgeted hours I need to do a calculation for. So I will take the budgeted hours per unit times the units. So what was the budgeted hours per unit for labor hours? It was 1.25. And therefore, I need to times that by the units, and the budgeted units were 10,000. That gives me 12,500 budgeted hours. The final one that I want to calculate is the flexed hours. So flexed hours will be your budgeted hours per unit. I said per units, so sorry, let's delete the S. Per unit, and we times that by the actual units. So here we times by the budgeted unit when we calculated the budgeted hours. Now we're going to take the budgeted hours for a unit and we're going to times it by the actual units. So it will be 1.25 and we need to times that by the actual units of 9,000 units, which gives us 11,250. The budgeted rate is easy. It was given from the question. They tell us that for the fixed cost, it is 13 Rand 60 per labor hour. You can even go back to the standard cost card and see it. So there's the rate, 13 Rand 60. So that needs to be filled out there. And from this, you can now calculate your volume variance, your capacity, and your efficiency by also applying the following mindset. If you want to calculate your capacity, it will be the actual hours minus the budgeted hours times the rate. If you want to calculate your efficiency, it will be this 11,250 minus the 10,800 times the rate. So basically we start in the middle and I always calculate my fixed cost variances in alphabetical order. So I first do my capacity, which is actual hours minus budgeted hours times the rate, which is this 13 Rand. Then I do efficiency, which is my flexed hours minus my actual hours times my rate. So again, I start in the middle, I minus to the right. In the first column, I minus the middle. If you add up your efficiency and capacity, you get to volume. So it's important to remember that the volume variance is capacity plus efficiency. But you can also use a formula to calculate it. If you want to calculate the volume variance, you can say it is your flexed hours minus your budgeted hours times the rate. So from this, you can calculate all of them by just applying the same mindset as you would in the top calculation. All right, then we are on our third calculation, our third support calc, which is my total budgeted profit. And the total budgeted profit is basically just a calculation to see what all the budgeted profit will be. And this is also the calculation that you start with in your actual reconciliation. So for total budgeted profit, we're going to say, all right, the budgeted sales price was 180. And then I can just take all the costs that I've calculated at the top. So there's all my costs. So I'm just like a lazy person, going to copy and paste it in here. And then I'm going to take the unit cost and I'm going to minus it in the support calculation number 3. Right, so my profit will then be per unit. Will then be the sales price minus all the costs, the direct material, the direct labor, the variable overhead, as well as the fixed overhead. There's the budgeted profit. Then I'm going to times it by my budgeted units, and that is 10,000 budgeted units. So my total budgeted profit is then that amount times the units. Right, and after doing these support calc, you can now dive into the actual required part, which is your reconciliation. So it seems like a lot of calculations to do, and it is. But once you've done them and you've spent your time doing them, you know for sure in answering your reconciliation, your calculations are correct. The reconciliation, doing it straight up from the information, is very difficult. Students make errors in applying the formula and you don't get it to balance. So in doing this, it's going to take you an extra 15 minutes, but then you know your recon is correct and you score all the marks for that question. Right, so here's the reconciliation. And we start now, and this is the part that the lecturer will actually mark. And of course, if you've made an error, we can go back and see what calculation you've done. And apply principal marks there, but we start by marking this reconciliation. The reconciliation starts with the budgeted profit, and the budgeted profit we just calculated to be this 466,000. Then the first variance, and we will not tell you these variances, you need to know how to calculate them. So the variances that we're going to calculate from support calc number 1 is direct material rate, direct material, or rather they call it price, I beg your pardon, direct material quantity, then there is direct labor rate, direct labor efficiency, we have variable overhead rate, variable overhead efficiency. Right, and all this I can now calculate from my support calc number 1, because the rate and the price variances will be column 2 minus column 3. The quantity and efficiency will be column 1 minus column 2. So to calculate the material price variance, I am going to say it is the 799,200 minus 828,800. For direct material quantity, I'm going to say it is 777,600 minus 799,200. For direct labor rate, I'm going to say it's 194,400 minus the 205,200. For the efficiency, it's going to be the 202,500 minus the 194,400. So you start seeing the pattern here. 202,500. For the variable overhead rate, it is going to be the 6,4,800 minus 70. And for the efficiency, it is 6,7,500 minus 6,4,800. Right. Just want to see if I say equals paste. It doesn't work. Right, I'm just going to go back and say, so material price will be this minus that. Material quantity is this minus that. Right, please note that you need to indicate that whether these variances are favorable or unfavorable. Clearly, if it's a minus, it's unfavorable. If you get a positive answer, it's favorable. So for direct labor, the rate is going to be this minus that. For efficiency, it's going to be column 1 minus column 2. For, let me just fill in, that is unfavorable and favorable. Then for the
Variable overhead rate, again, it's this column minus that one. And for the efficiency, it's going to be this minus that. Again, I need to indicate it's unfavorable, and it is favorable. Then the sales. There are two calculations to do for sales variances. The first is our sales price variance and our sales quantity variance. For the sales price variance, we're going to do the calculation again from the support calc number 1. So for support calc number 1, we will consider column 1 the budget, and of course column 3 the actual results. So now we need to think whether it's favorable or unfavorable. According to the budget, we should have collected sales of 1,620,000. We actually collected sales of 1,656,000. So in actual fact, we collected higher sales than the budget said, and therefore it's favorable. So the difference between those two amounts is then 1,656,000 minus 1,620, and that gives me a sales price variance of 36,000, which is favorable because we made in real life more sales than we budgeted to. Then the sales quantity variance, there you have to apply a formula, which is pretty simple because you've done a calculation in support calc number 3 for the profit per unit. So you take the budgeted profit per unit, so the formula is budgeted profit per unit, and you times it by actual units minus budgeted units. So that will be our budgeted profit, which is 46 Rand and 60 cents. And 60 cents, I beg your pardon, and we're going to times it by 9,000 minus 10,000. So if you do that calculation, you get a negative of 46,600 unfavorable. Right, we are moving on to our last variances, which are the fixed cost variance. So as I said, I calculate them in order. So it is fixed capacity, fixed efficiency, fixed volume, and it is then also there is a fixed expenditure. Leave a line open. Right, so for fixed capacity, we're going to calculate that from our support calc number 2. And fixed capacity is then 10,800 minus 12,500 times 13 Rand and 60 cents. So there I'm going to say my calculation is then for the fixed cost, it is the 10,800 minus the 12,500, and we're going to times that by 13 Rand and 60 cents. For the efficiency, it is going to be the 11,250 hours minus the middle, which is 10,800 actual hours, and we times it by the rate of 13 Rand 60. These two added up together should give us the volume variance, or alternatively, there's a formula for the volume variance by taking the 11,250 and we minus the budgeted of 12,500 and we times it by 13 Rand 60. Right, so there you should get for your fixed overhead your fixed overhead capacity, I get negative 23,120.
For my efficiency, I get positive 6,120. And then the volume variance is the sum of those two, which is negative 17,000.
So it's unfavorable
and favorable and unfavorable. But please remember that the sum of these two give the total volume variance.
So I just put them in a block because when you add up to your actual profit, you must not count these two. You will simply take the volume variance into account because otherwise it will be double counting if you include these two in the calculation as well as the volume variance, because those two add up to the volume variance. Then we have the expenditure variance, which is pretty straightforward. It is just the budgeted fixed cost minus the actual fixed cost. So what will be the total actual fixed cost?
Right?
And if I look at my information, it is based on labor hours, which is 10,800 actual hours. And I see that the actual fixed cost was given as a sum of 168. So what will be the budgeted fixed cost? The budgeted fixed cost will be, what do we have on our cost card? Per unit, the fixed overheads is 17 Rand. And how many budgeted units do we have? So the budgeted fixed cost will be the budgeted 17 Rand times the budgeted units minus the actual of 168. And if you do that calculation,
You should get to a positive 2,000.
Which is favorable. Right, now we need to go and see actual profit. And the actual profit is then a calculation of all the variances starting with the budgeted profit. So it will be this total plus that, plus the labor, the variable overhead, what is going on with this calculation now? 51. Right, plus your sales variances, plus only, oh, come on, T, plus only the volume for fixed, plus the expenditure, and that gives us actual profit of 384,000. So you can now go and cross-check your actual profit. So you can go and calculate actual profit. And that you can do straight from your calculation that you did here in support calc number 1. So I'm going to say copy and paste it in here, and we must just remember to add the fixed cost. So there we had the material, the labor, variable overhead, the sales, and of course we need the fixed overhead here. The fixed overhead was given as 168,000 for actual result. So I can just calculate the actual profit by saying it's the sales minus all the costs. So there's the material, there's the labor, there's the variable
overhead, there's the fixed overhead. And you will find that this answer corresponds with
the actual profit calculated by adding and subtracting all the different variances. All right, so this was the complete explanation of your calculations that need to be done for standard costing. I hope that this video has helped you a little bit. And if you have any other questions, you can stop by my office. Good luck with the preparation for your test.